Milan. Today I will be doing classwork 1, adapted from DBE Grade 12 Accounting Notes. It says the following information was extracted from the financial records of Veritas Limited. We need to prepare the cash flow statement and the notes for the year ended 28th February 2023. And under information, we are given extract from the statement, from the financial statement for the year ended 28th February. We are given information for 2022 as well as 2021. And we are given basically all the information that we will need, mostly to prepare note number 1. And well, we've got interest on loan, we've got depreciation, we've got net profit before tax, which goes to note number 1. And depreciation will go to your tangible assets purchased. When you calculate tangible assets purchased, we need income tax to calculate tax paid. We need dividends on ordinary shares. So when they give it to you as dividends on ordinary shares, you just need to know that those are this year's interim dividends plus this year's final dividends. All right. Now for 2023 financial year, interim and final dividends for 2023 amounted to 473, and for 2022 they amounted to 380. You will also notice that we were not given depreciation for the current year, so we might need to calculate that. Moving right along. Now we are given more extracts. So we are given extract from post-closing trial balance on the 28th of February. So this is after all the adjustments were made, and basically after all the adjustments were taken into account. And we'll deal with each as we go. Let's move on. So what we have under additional information, they said 40,000 shares were bought back during the financial year at 8 rand each. I will take that straight to my statement of cash flow under financing activities, because that will be your cash outflow from the repurchase of shares. They said no shares were issued, so basically we don't have any new shares or proceeds from the issue of shares. They also specified in number 3 that a vehicle was sold at carrying value for 24,000 cash. So that 24,000 cash is proceeds from the disposal of non-current asset or tangible assets. So it will go under investing activities as such. And then they specify that no vehicles were purchased. So there were no purchase of tangible assets, and there were no purchase of vehicles, there were no purchase of equipment. However, I wonder if we do have land and buildings. We will need to check that out. Let's try and prepare cash generated by operations, which is a reconciliation between profit before taxation and cash generated from operations. And here we know that interest has been capitalized. We need to refer to the information booklet for information relating to Veritas Limited. We need to complete the reconciliation note between profit before taxation and cash generated from operation for the year. And we also need to prepare the cash flow statement for the year ended 28th February 2023. You may use calculation blocks below the reconciliation note to do your workings, but your final answer must be written in the reconciliation note. Now, in my reconciliation note, they started with net profit before taxation. That information, I can only find it in the statement of profit or loss. So I'm going to go straight from the beginning. And from this extract, I'm given net profit before taxation for this year, because we're preparing the cash flow statement for 2023. It will be 420,000. Take that 420,000 and write it here as profit before taxation. Then we've got adjustments for. The first adjustment for will be for depreciation, which presents a problem for us here. We are not given this year's depreciation. Okay, it is a question mark, which presents us with a problem. Okay, but we need information that will help us calculate depreciation. We are given land and buildings. Obviously that won't help us because land and buildings are always at cost, but we have carrying value, of equipment at the beginning of the year. We also have vehicles at carrying value at the beginning of the year, which will help us. However, because we are giving carrying values, we will need to do the tangible assets purchased calculation. It'll guide us and it'll give us the information that we need. I will start with my land and buildings. And land and buildings at the beginning of the year, you will have noticed that it was 1.3 million and 29,120. We don't have additions at cost. It doesn't have depreciation, and no land and buildings were disposed. Land and buildings at the end of the year will be 1,438,980. We are missing that X, which is additions. So you will simply take the carrying value at the end of the year, which is cost for land and buildings, minus cost at the beginning of the year of 1,329,120. And that will give us land and buildings purchased amounting to 109,860. For vehicles, we were given vehicles at the beginning of the year, but at carrying value, now which was 369,080. We know that there was a vehicle that was sold at carrying value, which makes our life easy because we don't need to know the cost price of that vehicle that was sold. We don't need the carrying value of that vehicle. We don't need accumulated depreciation of that vehicle as at the date of the sale, which is brilliant for us because it has been calculated for us. All we have to do is to take the carrying value and put it in brackets. Disposal at carrying value will reduce the carrying value of vehicles we had at the beginning of the year. They told you that there were no vehicles purchased. So under additions at cost, we'll just put 0 there. We are missing depreciation, but we were given carrying value at the end of the year, which is 279,800. Apply reverse operations to calculate depreciation by taking 276,800, add 24,000, and then minus 369,080. It will give us depreciation on vehicles, and depreciation on vehicles will be the difference that I just spoke about. However, I just want to do equipment quickly. Now, for equipment, carrying value was 244,640. We don't have additions and we don't have disposals for equipment. We are also missing depreciation. I'm going to do these ones concurrently because the calculations are pretty much the same. Now, I'm going to calculate the first X I'm going to calculate will be the X under vehicles, which is vehicles, depreciation of vehicles. And depreciation of vehicles will be 68,280. Depreciation on equipment will be 56,000. This will represent the total depreciation for the current year because only vehicles and equipment are depreciable. Land and buildings are not depreciable. That information will be written in note number 1 as depreciation. Remember, depreciation for the year will be added together. It has been subtracted already in that 420,000. We are simply going to add it back because it's a non-cash item. Then we've got interest expense for the current year. Now, let's check if we do have interest expense for the current year. Okay. Sending me too far. Interest expense, which is interest on loan, is 19,500, and that's all that is given to us, and that's all we can record. All we're going to do is to take that 19,500 and add it back under adjustments for. That is because interest paid will be shown separately on the face of your cash flow statement. We did this as part 1. When we introduced the cash flow statement, we are going to add profit before taxation, depreciation, and interest expense together. It will give us operating profit before changes in working capital. Now, let's go to changes in working capital. You know already, under changes in working capital, the first item will be inventory. Okay. Let us go back to the information that we given for the current year and the previous year. We don't have inventory. This side, let's go to this side. We do have trading stock. Trading stock for last year, it was 126,700. For this year, is 206,900. Your inventory went up, and that is not good news. The fact that inventory went up, it means you purchased more. It resulted in a cash outflow. Hence, you will write it here as increase in inventory. In brackets, you will have 206,900, subtract 126,700, and your cash outflow from inventory will be 80,200. The next one will be trade and other receivables. Now, this is a problem because here stuff has been separated. You will need to remember what goes to trade and other receivables. The first item that I notice here is debtors control. Do I have any accrued income? I don't see any. Do I have prepaid expense? I don't see any. Basically, when it comes to trade and other receivables, the only item I've got is debtors control. Now, you're going to take that debtors control. It has increased. Last year, it was 105,300. This year, it is 128,300. The increase in debtors control is bad news, as it means you took your money, you bought stock, and then you sold that stock to your debtors who hasn't paid. So you've lost money that you're not getting back. How do we know that they haven't paid? It's because we gave them more. Our debtors control increased and we lost cash as a result. Increase in trade and other receivables will result in a cash outflow. It doesn't matter what you subtract. You just need to remember what the increase or decrease does to the cash of the business. Cash outflow will amount to 23,000 rand. The next item will be trade and other payables. This is tricky because we need to figure out what goes to trade and other payables. The first item I noticed there is creditors control. The second item I noticed there is accrued expense. Remember, we only include accrued expense in trade and other payables only if it does not relate to interest on loan. And in most cases, it's when interest on loan is not capitalized. And here you are not told that that accrued expense relates to interest on loan. Therefore, we are going to include it as part of trade and other payables. I'm going to prepare a smaller Nyana table. I am going to prepare a smaller Nyana table just to summarize trade and other payables for this year and trade and other payable for last year. Trade and other payable is made up of creditors control as well as accrued expense. For last year, it will total to 206,560. For this year, it totals 209,120. There's an increase in trade and other payables. This is good news because it means we bought more on credit, therefore we saved cash. Increase in trade and other payables result in a cash outflow. And the difference between these 2 years will be 2,620. That 2,620, we are going to record it in note 1 as an inflow. Inflow means we show it without brackets. And I showed you the calculations. Make sure you show calculations in brackets all the time, which is 2,560. I'm not sure if that is correct. Okay, let me just confirm if it's correct. It's over 2,560, which is the correct value. The inflow will be 2,560. Okay, I am going back to note 1. I need to calculate my changes in working capital. I will punch this into my calculator. Let me show you my calculator. I will start by taking the fact that it's in brackets, it means it's negative. Negative 80,200 minus 23,000 plus 2,516. Okay. I don't know what happened there. It's minus 8,200 minus 23,000 plus 2,560 equal sign. It gives me 100,640. 100,640. And I'll show you those calculations in brackets, changes in working capital. It will be 100,640. Then you will take operating profit before changes in working capital, added with changes in working capital. It will be 563,780 plus 100,600, plus negative 100,640, which is basically the same as minusing 100,640 from 563,780. My cash generated from operations will be 463,140. That 463,140 will be recorded on the face of your cash flow statement under cash flow from operating activities as cash generated from operations. It will be that 463,140. Next, I am going to do note number 2, which relates to bank. Bank, they said it's favorable. Last year, it was 20,000 on the credit. Please note that when your bank account is on the credit side, it means your receipts were less than your payments. And when your payments are more than your receipts, it indicates that you are having a bank overdraft. So last year we had negative 20,000. And this year we've got a positive 22,720. Basically, your bank account increased from negative 20,000 to positive 22,720. Clearly, for that one, there is an inflow. It's a net inflow. I'm trying to look for petty cash as well as cash flow, and I don't see them. Therefore, that bank amount is the only one that we've got. And we will use it to prepare note number 2, which determines your net change in cash and cash equivalent. And I indicated the amounts there. Now to get the movement for this year, all I'm going to do is to take this year's amount or total of 22,720 minus the negative amount that we had last year. When you minus a negative value, it becomes a plus. So it will be 22,720 plus 20,000. And this is how you will do it in the calculator. You will take this 22,720 minus negative 20,000 and press the equal sign. It'll give you 42,720, which is the net cash movement. We have nothing relating to cash flow and petty cash. That amount will go right at the bottom of your cash flow statement. Last year's amount will go to balance at the beginning of the year, and this year's amount will go to balance at the end of the year. To work out the net change in cash and cash equivalent, you take the balance at the end of the year, you minus balance at the beginning of the year. But because we are minusing a negative balance at the beginning of the year, it will end up giving you a positive value, which will be 42,720. Done. Bit by bit, we're getting there. Next, it'll be interest paid. For interest paid, I will simply take it as it is because it was capitalized. Take it as it is from your income statement, and that will be your interest paid. And that interest paid will be recorded under operating activities as such. And it was 19,500. Now let's discuss dividends paid. Dividends paid, the information I'll be looking at will be in trade and other payables. I'll be looking for shareholders for dividends. Last year's final for shareholders for dividends was 60,000. This year's final is 108,000. The 60,000 we were owing last year, we are obliged to pay it this year, but the 108,000 will only be paid next year. Basically, when we prepare the dividend paid, the 108,000 will not be shown in brackets. It will be shown without brackets because it will only be a cash outflow next year. We are simply missing interim dividends, but we were not given interim dividends. If I remember very well, we were only given dividends on ordinary shares for 2023 amount to 473,000. That 473,000 includes this year's final of 108,000. I can easily calculate dividends paid here by taking that 473,000, 473,000, 473,000 minus this year's final, which is 108,000. It gives me dividends, interim dividends of 365,000. And then you take those interim dividends of 365,000, you add them with last year's final, which was given to you as 60,000. And let us do that. Add it with last year's final of 60,000. It will give you dividends paid of 425,000. That's a short way. Just find this year's interim, you add it with last year's final, it gives you dividends paid. Or you follow this method that I taught you in the previous videos. And very important for you to check out the previous videos. You'll start with shareholders for dividends at the beginning of the year or previous year, which amounted to 60,000 and must be paid this year. This year's dividends on ordinary shares, which we get from your retained income, which is this year's interim plus this year's final. It was in brackets, and that is 473,000. But that's a lie because that 473,000 this year's final were not paid. That's why we add them back, and it'll give us dividends paid amounting to 425,000. Take that amount, put it in the face of your cash flow statement as dividends paid. Note that that note might not be asked in the exam. So basically, you might have to show all the calculations in brackets like I've done here. Last year's interim, it's minus. This year's dividends on ordinary shares, it's minus. This year's final dividend will be plus, and that will give you dividends paid amounting to 425,000. Or you can calculate it the way I showed you, which is the shortest cut. Let's calculate taxation now. For taxation, what we got? What we got? What we got? What do we have? We know that income tax for this year it's 147,000. We will use that, but let us check what we have when it comes to SARS income tax. SARS income tax for last year, it was 8,280 credit. It means last year we were owing SARS. So we need to pay it this year. Oops, it looks like even this year we are owing SARS. So that 5,220 will only be paid next year. For this year, we will show it without brackets. The income tax that you show, well, that they showed you earlier on, that you saw earlier on, will be in brackets. We'll start with last year's balance. It must be in brackets because it was in trade and other payables. This year's income tax expense from the statement of profit or loss will be 147,000, put it in brackets. And this year's SARS income tax was also entered in other payables, but it will only be paid next year. We show it without brackets for the current year. Your taxation paid in total will be 150,060. Please note that I'm putting this in brackets because it's a cash outflow. I know some students were taught not to put it in brackets. It makes your understanding easier. You won't confuse yourself when you put it in brackets, because when you do your cash flow statement, you know where if it's in brackets, it's an outflow. If it's not in brackets, it's not an outflow, it is an inflow. What I've just said, I've just written it there as a bubble. Check it out. You can read. It's basically everything that I said. Now, that amount of taxation paid, I will put it in the face of my cash flow statement as taxation paid and show workings in brackets. Taxation paid will be 150,060. Now, let's calculate cash flows from operating activities. How do we do that? Cash flows from operating activities. And this is how we are going to calculate it. You will simply take the 463,140 minus 19,500 minus 425,000 minus 150,060. That's incorrect, and 16. Okay, equal sign. It gives me negative. No, it can't be negative here. It's 463, 140, that is correct, minus 19,500, minus 425,000, minus 150 and 60. Oops, it looks like it is negative. Basically, cash flows from operating activities will be negative. Well, it's actually not negative here. I don't know where I messed up. Let me just quickly recalculate everything. I've just corrected it, and it should be 131420. Now let's go to investing activities. Did we buy any asset? Well, we did this earlier on, as a matter of fact. We only bought land and buildings, okay? And that amounted to 109,860, and that's all we are going to include under tangible assets because no equipment or vehicles were purchased. That will be under investing activities as purchase of non-current assets in brackets because it's a cash outflow. If I remember very well, we sold equipment for 24,000 rand, which was also the carrying value of that equipment. Yes, there it is. Oh no, it's not equipment, it's a vehicle which was sold for 24,000. So that will be the only proceed from tangible assets. We'll put it under investing activities as such without brackets 24,000. Take 109,860 added with 24,000. It's negative 109,860 plus 24,000. It will give you negative 85,860. Under financing, if I remember very well, they said there was no proceed from the issue of shares. I think they said that. Let me just confirm. No new shares were issued, so we have no new shares issued. However, we do have the buyback there amounting to 40,000 times 8. If you remember the table that I did last year, or you can check out the videos, the table on shares, that table will be vital in your understanding what I mean by this. I'll include, well, proceeds will be zero, but we do have the buyback, which is an outflow of cash. Buyback of shares, you only look at the money we paid to buy back the shares, and that's what will be here. and that will be 320,000. I normally showed it as part of the bank in the table that we did where you calculate this, the buyback price basically. Yes, buyback price. So remember you had to take the buyback price minus APPS. APPS stands for average price per share, and then you will get either a profit or a loss. If your buyback price is more than APPS, it means that you made a loss. If it's less than APPS, you made a profit. Yes, that buyback is the one that you take to your cash flow statement. I hope I'm clear. Let us look at loans because those are the only financings, shares and loans. Let us look at loans. What are they saying about loans? What are they saying about loans? I'm going to go back to my information and compare loan amount for this year and loan amount for last year. If it increases, it means I got more loan. I was actually teaching this to the grade 9s today that when you get more loan, it will be in the CRJ because you're receiving the money. But when loan decreases, it means you are repaying the loan. So it decreases from last year to this year. And the loan here has increased. It means we received money. We borrowed more money. And that will be proceeds from the long-term loan. We show it without brackets. And the fact that we have proceeds, it means that we don't have repayments because there's nothing specified about the repayments. 320, negative 320,000 plus 580,000 will give you positive 260. Now, I'm done. I'm going to take this, right? Which is cash flow from operating activities. It's minus. So it's minus 131,420 minus 85,860 plus 260,000. It will give me the net change in cash and cash equivalent. If it doesn't, it means that you made a mistake. I don't know where, but you made a mistake. You need to correct it. They need to balance. And this is how you would check if your cash flow statement is correct. Please check this out. You just need to prepare the cash flow statement. Please pause if I'm too fast for you. Oh, already I'm showing you answers. Pause and check out the question. You need to prepare all the notes up to the cash flow statement. So all we want here is this. Okay. We want the cash flow statement, which is this. All right. Let me check the next question, classwork 3. You can also do this if you want to, okay? And then classwork, what's the next classwork? It will be classwork 4, okay? You can check it out and prepare the cash flow statement. And yeah, I've been focusing more on GDE there. This is also not GDE, DBE. This is also DBE. It's a past paper from DBE. Check it out and prepare the cash flow statement. Okay. They just want the cash flow statement, and that's it. Oh, they also want a retained income. Okay, so you need to prepare retained income note. And the last classwork, I hope it will be, it's this one adapted from 2016. Supplementary, it's an IB paper. Try it out as well. Okay, okay. And there you go. I like that third point from the bottom. If you watch the ratios, you will know how to deal with that because I explained under ratios as what that means, where they say the period for which the closing stock is expected to last is that. They didn't say all the stock, they just said closing. So you need to edit your formula there. Obviously, let me check for note 1, what are you given? Or you're given that for note 1. So they want you to prepare note number 1 and the statement of cash flow. Please, if you need extra lessons, contact me or you can contact Mrs. Kujinga for accounting. She resides in Cape Town. So if you're around Cape Town and you want one-on-one lessons, please contact her and then you can meet somewhere there around Cape Town. Otherwise, you can have one-on-one or 1 by 2 online lessons on Google Meet or Zoom. Otherwise, contact me. For maths, please contact all those ladies there that will help you. All right. Otherwise, if you have any questions, please feel free to contact me. You've got my email, cell phone, and you can also link up with me on LinkedIn or face me on Facebook. All right. Kgotsong. Ke a leboha. Thank you for watching.